Investing in self-storage with a true expert, AJ Osborne. Why self-storage? How did you decide to go in on that?
So all of a sudden, all our focus was designed around revenue management, customer acquisition, and price per square foot, and different types of offerings and management style, and all the business.
Welcome everyone to the Directed IRA webinar. We are so excited to be here talking about investing in self-storage with a true expert, AJ Osborne. Aaron and I didn't want to come on here and talk about this because we know very little, and that would not be valuable. We decided we'd bring a guest expert on who knows this subject. We've seen some IRAs at Directed IRA, invest in some of AJ's deals. So I've seen him speak. I've followed his social media too, and been impressed with him. And I know Aaron had an opportunity to go up to AJ's event in Coeur d'Alene, Idaho, the thriving metropolis.
And it was a good one. It was a good one.
So what did you learn up there, Aaron?
Well, I think I got a page of notes here, like maybe a little small book of notes that I took. We got these moleskins, and it was my first self-storage event. I'm pretty well versed, as most of you know, in the real estate, mainly in the single family and distressed note buying space. But I had a huge lot of takeaways. I'll tell you the biggest thing that I learned. While self-storage people consider a real estate investment, it is that plus an operational business. It is an operational business. And that was like my biggest takeaway. It's not a wham, bam, thank you, ma'am, passive deal. I'm just going to set it and forget it. I'm going to collect my dividend or my cash flow checks. It's not that at all. It's, it has its own set of vernacular. It has, fully operational business and different software platforms and a ton of automation and AI that you can employ as well. A lot of security. But it was like super eye-opening. And also noticed it was like a very welcoming, smaller niche too. And a lot of small mom and pop operators out there still that own a large portion of these facilities. And AJ just put on a world-class event. The community he's built, the education, the content, the level of speakers, and they're like super giving and open, and talking about what they do to operate the business. So those are some of my big takeaways. We had another one of our awesome relationships that we've started over the past few months. Pace Morby keynoted as well, so that was cool to hear some of his key takeaways on like story selling and storytelling. Was awesome. So yeah, great event, AJ. Thanks for having us. Directed IRA was a sponsor there, and well received, well loved. We really appreciate it. It was awesome.
Oh, thanks you guys for coming. It was the support was phenomenal. People loved it, it was a party, so it was a fun event. And
so it's not a conference; it was a party.
That's right.
We had dancing and a barbecue and fireworks and a boat ride. Like, my God,
that's cool. Awesome. All right, well, let's share some slides. I'm going to do a little intro on AJ here, and we do have a couple of slides. These will be up on the recording at directedira.com/webinar. But just want to give a little information on AJ. He has 300 million of assets under management in the self-storage space. AJ's also got a podcast on self-storage, a book on self-storage. AJ's carved out a niche, to say the least, in the space of self-storage. So let's dig into it, AJ. And I want to first kind of ask, and we can unshare the slides. I want to first ask you, AJ, how did you get in to self-storage, or where did you even hear about it first and decide, I want this to be my niche? Because you've clearly carved out a niche in this, and you may be in other real estate, I don't know, but why self-storage? How did you decide to go in on that?
Yeah, so we really don't do any other real estate. We are self-storage nerds and experts. So it's not even just the real estate that we own. We own a variety of companies within self-storage, everything from architecture, debt brokerage. I have a software company, multiple national brands. We do consulting work, but we own, operate, manage storage facilities, obviously, as well. That is our core business and where we get started. And, it's funny because when you look at real estate, we got started prior to 2008. And it was actually my father who convinced me storage because I wanted to do small multifamily. And because that's what everybody did, right? You're talking 2006, 5, right? So that's how you got rich. It was single family homes. It was small multifamily at the time. And I was like, we need to do this. We need to go big into it. And the thing that we looked at, first of all, we were insurance brokers. Okay. So we did group medical. Everything's cash flow based, right? Yeah. So it's just, we're sales, everything's cash based. And I didn't really fundamentally, I think, understand all of the value of real estate. So when we were looking at that, to us, it didn't make money. And people were like, no, you get rich. And, there's all these things you can do. And I didn't know anything about equity or appreciation. I just looked at it and I'm like, I don't get this. It doesn't make money. And so my father said, well, look at this. And we looked at a P&L of these storage facilities in these small cities and towns. At the time, storage was not something people talked about. It wasn't something people wanted. It was a trashy asset is how people basically viewed it, right? Mm-hmm. It was kind of like a junkyard. And so we're talking 12, 13 caps. And we were looking at these things going, well, I don't know a lot, but the cash flow is awesome, good margins. And we can improve the cash flows. And that was the difference. And that's why we went into storage and stayed in it, was because we could do something to affect the overall revenue and to affect value of commercial real estate. You have to increase net income. And that was something we had control over. As the other assets, it seemed like the pitch was simply, Mr. Market will make you rich. Yeah. And I did not like that at all. And so that's how we got in and stuck with storage.
Okay. So you kind of focused on the cash flow aspect of it.
Yes.
And then also you did approach it as a business and seeing where you could add the value to it, operate efficiently to drive, better performance. Maybe the prior operator kind of sounds like what did you learn after the fact? I mean, that's what got you in, right? Yeah. Was that concept, but what did you learn after the fact once you got in it? Were you right? Is that still the number one driver of, if you think of wealth accumulation from it, is that still the number one driver of that? Is the cash flow from operating?
So the overall appreciation equity part that came after 2015 and 16, which blew everyone away. That it was so shocking that people if I could go back and say, hey, people want you to come onto a webinar to talk about storage, I'd be like, no, I don't talk about storage. I don't tell people we're in storage because they're like, what are you, junkyard king or something? Yeah. And so nobody wants to talk about that. Right. And that would have blown me away. I think it blew everybody away at the equity creation that storage had, because you're talking over the last 3 years that ended up trading at similar cap rates to multifamily. Yeah. Which that doesn't make sense. Right. But what we learned very quickly was cash flow was great when you start out, but we were missing very much large pieces of the pie. We could force and create equity, but we didn't have a way to capitalize on it due to the markets that we were in and due to the types of assets. So we actually ended up selling off all our small facilities in small locations. We moved into cities that had better, more fluid markets of both buyers and sellers, and had more larger buyers and sellers that actually gave us some stability on value, that it was measurable and we could do that. That changed the way banks looked at it. And so we developed a strategy where I said, I can't sell the asset because I need the cash flow to pay for our company that's running it, because there was no third-party management. We had to build it. So instead we said, what we'll do is we'll buy these assets. We'll double the net income by going through performance. We'll refinance them. We'll take that equity out now tax-free at the same rate that we bought it at. It's still 70-30. And then we'll take that equity and then we'll buy another one. So then now we can get our compounding effect. And we still had the cash flow that would still pay the bills, and we didn't lose the asset. So that's what we did. And we needed, though, in order to do that, we needed to really focus on underperforming assets and then how we make them perform better. So all of a sudden, all our focus was designed around revenue management, customer acquisition, and price per square foot and different types of
Yeah.
offerings and management style and all the business stuff.
Yeah, that's all business words, right? Customer acquisition costs, revenue per customer,
Yep.
price per square foot. I mean, that's an operating business. So what should someone know? I think we have a lot of real estate investors, a lot of people investing that know single family real estate, that they've invested in multifamily real estate. They've either operated and owned those things themselves, or they've invested in funds for those types of opportunities. But help me understand that, and everyone else, for, okay, you want to do self-storage now, or you have an interest in it because you believe in that as a growing asset class and there's value and opportunity there. But if I'm looking at a self-storage, what do I need to know about that type of asset different than single family rental, even multifamily?
So there's a few things. First is the self-storage industry is extraordinarily sensitive to supply. So the number one threat of self-storage is self-storage. And the markets can be very easily overbuilt because it is a lower entry point. If you built 300 units in multifamily, that's going to cost you a lot of money.
Yeah.
And that is going to require major investors. That is going to require big financial institutions. And people are going to be checking, monitoring, looking. Well, that's not true in self-storage, right? You can build 300 units for a few $1,000,000. And so you can get away with friends and family, and then you can go develop. And so you get lack of expertise that will come into the industry. They don't do market analysis and study, and they build, and there actually wasn't enough supply. That suppresses market rates and creates increased vacancy. So the number one thing you need to know is that demand is everything. And we commoditize very quickly when you're oversupplied. So if you can avoid, I often say you could be the best self-storage investor in the world. And if you're in a market that's oversupplied, you're dead. You can be the biggest idiot in the world. And if you're in a market that is undersupplied, you will be wildly successful. You don't even have to do anything. Mm-hmm. And the thing is, don't fight the market. Don't try to. So that's first. Demand, 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 demand. Second, operations. This is an operations game. I am competing in my market for the customers. I am actively going out and trying to get customers, not get them into my competitors. We use a lot of technology. We do things like revenue management, dynamic pricing, and the competitors are getting better. And private equity has come in to consolidate this industry, realizing what they need to do to compete. And the amount of capital that's gone into tech is staggering in this industry because it makes a massive difference. So when you go into it, you need to be ready to compete, and you need to be good. And you should never underestimate how that works. A lot of people think, oh, there's no toilets, it's easy. And then they get it. And then 6 months later, they call guys like us because they're like, I am done with this thing. Yeah. We have turnover. We have tenants coming in and out all the time. We have to be filling doors. We have to be actively doing it. It acts more almost like retail.
Yeah. So let me go back to the first one on demand there. So it's interesting you bring up the word commoditized. I want to make sure everybody gets that point, because I think that's really important for any business to make sure you understand, like, how unique are your services, your product offering and as you can your industry get commoditized, where it's like, I mean, it's not like a home, right? Like your self-storage facility doesn't need to be on a nice street. It doesn't have to be in a good school zone necessarily, right? Yeah. Might need to be convenient, you don't want to drive too far for it. But it can be commoditized in the sense that lower barrier to entry, like you said, compared to multifamily. So easier to have competitors. But I think that's really interesting on the demand side. So how does someone assess whether there's adequate demand in a market if they're looking to buy an existing deal or build something new? It seems like what you're talking about. Like, how do you know, like, how do you assess that market?
Yeah. So if you're doing an acquisition or building, right? Obviously, if you're building, it's way even that more important. But even acquiring, because of the prices that storage facilities are at today, they're not cheap. And so if you acquire it and you have decelerating rents, that's a big deal. You have to realize we have markets where certain rent sizes and everything are down 60%, because that's the good thing about storage is we can move fast. So it is one of the best hedges against inflation ever. Everybody else was complaining about inflation and, oh, I've got these locked in leases, everything. And I'm like, I already moved up our rents by 15%. So the best things about storage, though, can also be the danger, because then if I have vacancy, all right, well, that $100 unit, I'm just going to give it away for $30 and I'll have move-ins.
Yeah.
Well, if you are a customer and you're looking at 3 facilities and one's $100 and the other's $30, how much of a difference does the $100 one have to be, because it's a metal box with cement, right? So in order to figure out that, you need to look at a few things. Now, a lot of people say square foot. So how much square feet per capita is on the market? I actually dislike that greatly, because it's not a good, some markets can utilize 15 square feet per capita and stay fully occupied and raise rents, while other markets, they can't at 6 feet. So what we look for is overall occupancy and historical rates. And I want to see a correlation, meaning this: if occupancy or if rates go up, did occupancies drop? And how elastic are those rents? And so how tight is that demand? I also want to see, if any storage facility came in, how long did it take for it to fill up? The next thing I want to do is make sure that I understand future demand. So future demand being, is someone going to build? Are there permits given? Somebody builds in a town, in a smaller city that has 3 storage facilities, and they put 60,000 square feet on, they may double the total square footage on the market. Well, you don't know if there's actually demand for that, and there may not be. And it could take years to actually fill up and to do that. So you want to be able to measure, and anything that you can't, you need to know its impact. So if somebody is building, they're putting 60,000 square feet on that market, and we have 600,000 square feet of storage that is full. Okay, well, that's 10% increase, right? Well, now maybe that market can handle 10, but is it 50% or is it 60%, right? So understanding the demand and the correlation between prices and occupancy, and then also square footage on the market, its absorption rate, and then new ones coming on board.
Okay. Love that. Excellent. Gosh, you kind of know this stuff, don't you, man?
I'm a big nerd.
Yeah. Well, let's, tell me, I want to get into kind of like investing in this, because I saw in one of your social media posts, you talked about raising money on you. I think kind of the first deal you raised money, you had some problems on.
Yeah.
Tell us about that story and kind of that experience that you had. Cause I know you have, you have a fund, you have that 300 million. I don't know how much of it is capital raised from others and such, but you definitely have raised a lot of money in this space. But what was that lesson learned on that first deal?
Yeah. So I appreciate you bringing up my embarrassing stuff. That's great. So, the reason it's embarrassing was because when I started raising money, I already had a portfolio of 150 million in assets. Yeah. And so I was already in 4 states. I had an operational company and everything. And then I raised money, and we bought the storage facility. And 2 things happened that had never happened to me before on a storage facility in 15 years of doing it. This has never happened.
Murphy's
and of
Law.
course, it's when I took other people's money, right? First time. And the things that had happened was, first, we had leaky roofs, which had passed an inspection. So we had had an inspection passed, and then all of a sudden a storm came right after we bought it, and we found all these roofs were leaky. That stuff happens, right? Okay, we got to fix the roofs. It's whatever. But we also, after we closed, we took over the management. We found out that the leases that had been given to us by the owner were old leases, and there was actually not one current lease with an existing customer. That has never happened. We always have customers that don't have good or fully executed leases, but never all of them. So I have leaky roofs. I need to get people out so I can fix roofs. And I do not have any legal contract with them to kick them out.
Yeah.
So that they're the 2 worst things that could happen right at the same time. And that was the first deal that I ever raised money on. Now, luckily for us, we buy conservatively. We know what we're doing. We never had capital calls. We never had anything else like that.
You had margin for error in the deal. It's a little
we had
margin
margin
for
for
error.
error. We lost 30% of our occupancy the first year because we had to get tenants out. But with that 30% loss in occupancy, we were still making the exact same amount of money because we knew how to offset it.
Yeah.
So 30% vacancy, yet we were still making the exact same amount of money and able to give distribution. So it worked out. But if we hadn't been more veterans in the industry and knew how to do revenue dynamic pricing and revenue management, we would not have been able to offset a 30% loss in occupancy.
Yeah,
and
that could have crushed
been,
a new operator.
Absolutely.
That couldn't come back from that.
Yep.
Talk to me about the leases though. So how is a typical lease structured in self-storage? And what are the, I think like the terms of that, length of it, how's that different than a typical residential lease? And what should someone be looking for in these leases in the due diligence? Obviously, in that example you shared, thanks for sharing the tough deal. I appreciate that. That's the thing.
Great way to
AJ's a winner. AJ's a winner. He's got lots of winners. You always learn. That's where you learn,
That's right. Yeah. My failures are always way more interesting than the wins.
Tell me about the leases though.
Yeah. And two, by the way, failures. I've never lost a deal, gone bankrupt, anything else like that. That's never happened. When we look at the overall lease structures and storage, the lease structures are favorable and we've built operations around them. They are month to month. And they basically say, you're putting your crap on my floor and you're paying me X price. And if I don't want you to, you need to get your stuff off my payment and leave. Right. And so every single state is different. So every single state.
But California is probably the easiest one. Yeah.
You know what? I wouldn't know because I'm not buying in California and I wouldn't. So because of
okay, that's the answer.
The essentially,
I feel like as a tax and business lawyer, that's always my caveat. And you should do this and do that and use this and that. And then unless you're in California, then
unless
another whole conversation. But
yep, exactly. And so the leases though are nothing like
okay, so residential month. Is that kind of standard?
We can pretty much do whatever we want. There's a set given time that I could kick you out for basically any reason. I don't need a reason. But if I kick you out, there has to be a certain amount of time. So like you have a 30 days to get out, or some places it's like, month and a half. So it depends on the state. But I can kick you out for any reason I want. So that allows us to move quickly, raise prices, get people out that we want, get new people in. So it's really beneficial, and there is no squatting laws. In fact, it's opposite. It is illegal to live in a storage facility. So if you're in there, I'm going to call the cops, and the cops can come help me rip you out and get you out, because that's very illegal.
Yeah. So, we've all, I think, what is it? Storage Wars and some of these shows,
yes.
Is like, if people aren't paying even and they don't come get their crap, like you just go auction it off and
yep. You sell it all off.
Yeah.
Now there's
anything weird
there's
in
a
storage
misnomer that people think that we make money on that. Yeah. We don't. So how the laws work is I can only make up rent that wasn't paid. Other than that, I actually have to give the money back to the tenant. So there's no profit for us at all in auctions. In fact, it's always a net loss. We've never once ever had like a time where our auctions made us money. So that's another reason why it's really, really important for us to be able to kick people out, because once they stop paying, it's what our loss is, our revenue potential. That's our big loss. We got to get those people out and out fast. The longer it goes on, because the average auction is like, I don't know, probably $15. It's nothing because it's crap. And most of the time they've already taken the stuff out.
Yeah. They left all the garbage behind. Yeah. If there's something valuable and they're in a pinch and they can't even pay your fees, that means they came and grabbed it. Unless
100%.
Got it. Okay. So the storage wars aren't really true, pretty much. People finding some expensive piece of art or a motorcycle in there or something. Well, okay. So let me ask about, so there's no there's like the eviction rules and stuff. We're not worried about that because it's not a residence. It sounds like you mentioned there's some timelines you got to follow and some notice maybe. but we're not talking about
notices, public notices, which in most states we've been working hard, and I think in almost all states today, an email will suffice. So it used to be like we were having to actually send like documents and stuff. It was kind of crazy, but in the email, but you have to give written notice.
Okay.
And then you have a countdown, until they can leave from that point. And if they aren't paid up and if they haven't moved, which we overlock. So what we do is you haven't paid, we go take our lock it on the door so you can't get in. And then we say, you pay us. If you don't pay us, that lock stays on. And if you don't pay us up until that point, we're selling your stuff. And so we have a month to hold your stuff to try to get paid. After that month, you don't pay, we do an auction, which is also, it's all done online. So it's like a national online portal for auctions. We don't house them. People don't come to the site like they do in Storage Wars. It's all done online.
Okay. Interesting.
I did have a question on the auction that I learned from networking and talking to people, and just correct me if they're wrong what they were sharing. But what they were saying was like, it's more important for us it doesn't really matter what we're getting for it at auction. We want to get the stuff out as quickly as possible so we can get rents in there again. And it could be 100%. It could be $1.
We don't care. We want it out and gone because once again, we can't make a profit on it. And we know that 9 times out of 10, we won't even get a month's worth of rent even. So it's like, it's that holding up. They're holding our rental space hostage.
Yeah.
We just want it back.
Yeah. It's that vacancy, that lost opportunity to lease it out.
And two, it's work. Our managers, that's a pain in the butt. We've got to be documenting because there's all these laws. We can't go in it, but we have to document it. Right. So all of a sudden we've got to hold the auctions. We got to deal with other people. So there's a lot of work that we're not getting paid on. We don't like.
So let me ask you this. It sounds like is it industry standard to be month to month, or is that just something you do?
That's industry standard.
That's industry standard.
I don't know. I don't know one facility that does longer than that. That would not be beneficial to us. Okay. In fact, our business models are predicated on us to be able to move rates quick. So the Wall Street Journal and everybody have come out with a lot of information because they've kind of got a hold, and a lot of tenants are frankly pissed, and they probably should be, because what most of the REITs and what everybody basically does is, in order to get somebody in, we're going to price it at $50. Once you're in 3 months later, we're going to jack your rate up to 150. Yeah. So we use a teaser rate to get you in, and then they jack your rate up. If you had long-term leases, the average stay for storage is only 14 months. We would never be able to get those price increases up, and we would never be able to get our average rent up. So in competitive times, long-term leases can literally destroy your ability to pay your bills.
Okay. All right. Tell me why you went, because it sounds like you were doing your own deals, getting equity out, getting the next deal, building your empire. You had your own operating company. Sounds like you have technology companies now and other areas you provide services in the self-storage space. But when did you decide to go out and raise money from others and start a fund? Why did you decide to start doing that?
Yeah, so it's an interesting story, and I guarantee it's one that, and I guarantee it's a reason that no one has ever else had. So money wasn't something we were actively looking for or needed. We had our assets. We had less than 50% LTV on a very large portfolio. We're in the top 70 in the world, and we liked doing what we were doing. Right? There was no podcast, there's no webinars, there's no social media, there's no nothing. We just did our thing, and we built companies, and we ran our cash flow. But I became a quadriplegic out of the blue. So one day my legs stopped working, and within 24 hours, I was put on life support, and I was hooked to tubes, and there I stayed for months. I actually was running a huge benefits brokerage firm, and I was they kind of had golden handcuffs on me at the time that I was also running our storage facility, and they fired me in the hospital, and I was at the hospital after a rehab facility. I'd gone from like 4 hospitals. I was in a long-term care facility. We just had our 4th child. And there was my husband there was my wife with 4 kids and a paralyzed husband. They were going to send me home paralyzed in bed, obviously. But I'd finally gotten to where I could transfer to a wheelchair at the rehab facilities. And frankly, I was just in shock about how lucky we were. It was Christmas Eve. I was going to go home for the first time in months to see my children open up their Christmas presents in my home. We didn't lose our house. We weren't worried about money. And I was like, my wife's going to spoil the kids. And it was because of storage. So right there, I said, all right, I'm going to do 2 things. I'm going to teach other people how to do this. And then I'm going to let other people come and join us on our journey. And so I started my companies out of a wheelchair after I'd gotten and was trying to learn how to walk. I had to relearn how to do everything, occupational therapy, everything else. And so from there, we set up our private equity side, and we just allowed people to come in and do the exact same thing we were doing. And I view it as a ride along. I say a lot of people start, they do funds and they use other people's money to build their companies and get wealthy, which that's not bad. That's how it works. But we're the opposite, right? Our company is being used to build their wealth and make them rich because that wasn't a part of it. We could have just stopped, never done anything again. But I needed a purpose, and I was looking for a purpose, and I had everything taken away from me. And so that's why.
Wow. Yeah, that was not the answer anyone would expect.
Nope.
Why did you start raising money? That's a remarkable story. And I think that process, and your determination to move into this, go all in on self-storage. I mean, it seems like it's given you purpose in many ways.
It
right?
has.
And that's when someone's unstoppable, really. That really is. I think someone can be unstoppable once they feel that purpose in their life. And but you also have something that you demonstrated you were good at. It sounds like you realized that as you were going through all that. Wow. Thank you for sharing that, by the way. That's pretty amazing.
Happy to. Thank you.
All right. If anybody's got questions for AJ, I know, drop them in the Q&A. Aaron's going to be grabbing some of those. We want to get to your questions. I won't take all the time, I swear. I will share because we want to make sure you guys get your questions in for AJ. And remember, this is going to be recorded. So get over to directedira.com/webinar later. If you missed any of the beginning of this, the full thing will get recorded and you can come back to view later. Aaron, I don't know if you have any questions you wanted to fire.
Yeah, I do. Can you hear me good? So I just wanted to go over your structure. Can you tell everybody how you're structuring it? Is it in a syndication? Yes. Is it a GPLP structure? Like, outline the different ones that you have.
So you may have noticed I do everything different. So this is something we do very different because first of all, we could. The structure that we have is identical to the structure that grew us to where we are. And what we do with our investors is we view it as a ride along, but so when you look at the structure of deals, that has to do with everything from waterfalls, all this other kind of stuff with that GP. So it's a GPLP structure, had to do with the performance of the asset. That didn't make sense to me. So we deal with the performance of the individual, meaning that ours is predicated around the individual getting their returns, and everything's based upon that. So we don't participate more. We don't get more unless they've received all their money back plus a 20% profit. And we allow them to stay in the deals long term. And we try to get that in 3 to 5 years. We've never not so far, but we are buying underperforming facilities. We take all the risk, all the liability. They risk their capital as an investor. They come alongside. We turn the assets around. We build them up. We refinance them at the same 70-30 rate. We're not taking on more debt as a percentage. And then we allow us to all get our money back plus profits, but we don't sell the deal and they stay in. And then we refinance and do equity conversions and take the cash flow again and again and again, because our idea is that we want them to compound their money too and be paid for it while they're holding it. So everything's predicated on their returns and how they come in. So it's a different type of structure. But yes, they are actual partners with us. They are LPs. They participate in all the tax benefits, everything else.
So is there, I mean, there's no asset under management fee or anything like that, or is there a?
Yep, we have
You have
a property
expenses.
management fee, which in
Okay.
storage is average is around with all fees for property management is like 7 to 15% because they take insurance, they take all sorts of stuff. We take a flat 6% off gross. We don't take any extra fees at all. We don't take because we self-fund like our insurance, and then that premium comes back at 80% to the store where most people take that. It's a good moneymaker for property managers, things. I don't like all this numbers and tricks and stuff. It's just 6% of gross. That's what we take. And that goes to run the properties. Storage is more operation heavy. And it's really predicated on the executing. And that's generally why property management fees, I think, are higher than the other asset classes. So
Yeah.
in general, I think, 8+% is not probably a norm, but I don't, it also has lower revenue than a lot like multifamily, things like that.
Yeah. Yeah. 8 and 10% property management fees aren't out of the norm in other assets. But so there's no there's no fund fee that's like an asset under management fee, like 2% of the fund value.
Yes, we have we have a 2% of gross revenue, which is teeny in storage. You're talking like $300,000.
Got it. So
it goes to asset management.
Okay, got it. That makes a lot of sense. And I get what you're saying now. So that's not about how much capital was raised or in the fund. It's at a gross rents or receipts or
yes.
Got it. Revenue. Okay. All right. Cool.
What are you doing with those that have self-directed IRAs or a checkbook IRA LLC or a solo K? Are you working with those kinds of
yeah, we just started that this year. And that was a big thing for us. And our deals, particularly for these tax deferred accounts, make a whole lot of sense considering that we're optimizing them, right? We're giving capital back plus profits, but we're also holding for the long term. So we found we didn't offer it before, and that was a huge driver. People were like, hey, I got this tax deferred account. I would love to build long-term wealth, long-term equity and income. And we're like, oh, we don't do that. And last year, we're like, why aren't we doing this? Like, this doesn't make any sense. So
yeah,
I have inside counsel. We have over 75 employees. And so we've structured that now to where we can take on that. And I'm actually really excited about it because there's a whole bunch of other things, even with our employees. What our big goal is we want to increase opportunity and access. So we're even working with a few different attorney firms to allow custodians to direct group
401ks
into assets and have a custodian that will look over it. So we're big on it. We're trying really hard to work through and allow more private placement into physical assets, not just the stock market.
Well, just talk to me, AJ. That's what I do myself. So
I have
125 employees, group 401k plan. I can't do a solo K. I got 100 employees. You think I mind mutual funds with my IRA? No. So we have a 401k plan that can be self-directed, and I have my accountant directed. It's a actual 401k. I have a Roth IRA too, and I use that to invest in real estate deals and do private lending. So
can you do it on a group basis, or is it only individual?
No, you can do it on a group basis. You have to have participant directed accounts in the 401k.
Okay.
And then you have to really get a record keeper and a process that works. It's kind of once you know all the legal rules and everything, which I'm an expert on that, that's the nice thing. But then it's like the mechanics of getting an administrator or a record keeper, like a Fidelity or we use Nationwide is one relationship that I've had because they allow for what are called outside investments. So I can take money off the platform. Everyone else, because you might have some employees that want to be like, I want to do a target date fund. I want to do a mutual fund. I don't want to do this self-storage stuff, or I want 2/3 of my money in this and 1/3 of it in that. You need to have the platform, right? For the regular investments, there's legal requirements that have to be readily acceptable investments and certain offerings available. But you can have this self-directed component where if someone individually wants to, they can take a portion of their account and go and make what like a record keeper would call an outside investment. So yeah, it's more tricky, but it can be done. And our law firm's done it. I've probably helped 30, 40 businesses do that.
Oh, we need to talk more then. I need to get you on account, because that's one of our big, we find it so weird because we have the accreditation laws and everything. And we're sitting here going, our workforce that aren't accredited investors cannot invest in the very assets that they are making successful and see day in and day out. And they all want to. And so we do obviously a 401k and a 401k match and everything. And we're like, they're taking their money and our money and putting it in the stock market.
Right.
And we literally do these and they see the returns, they see the assets, and they're like, why can't we do it? So that's a big goal of ours.
Yeah, I can definitely help you there. I love that conversation. And we'll be doing a webinar actually on self-directing 401k plans. Whether you're a business owner with employees and you want to do it for yourself or offer it to your employees. That's something I used to do. And I'll be honest, I'm like, I can set up 100 IRAs faster than I can do one of those group 401k plans. I'll just be honest, it takes a little work. But for the ones that are determined to do it, and it's especially for you, AJ, and like someone that's like, no, this is a core piece of our business. And I want our people to be invested in the deals we're doing.
Yes.
They want to be in it. It's definitely worth the time. It becomes a cultural thing within your organization of
exactly. We want the people to be invested. We want them to participate. So that's awesome. Yep. We'll definitely have to get your help.
Okay. All right. I'm willing to help. Okay. So, all right. Well, what else we got, Aaron? Any other questions you want to fire away for AJ?
Yeah. We'll come back and let's hit on some more IRA stuff, but what do you have to tell people, AJ? I think it's a common myth, but self-storage is overbuilt. It's oversaturated with inventory. There's tons of new facilities being built. Like, I can't compete. Like, what do you have to say to those people that are making those comments?
So there's two things. First of all, when you're looking at self-storage is hyper local. Like, it's hyper local. Your storage facility will attract in a 3-mile radius people. So if you could be in, if you're in Salt Lake, you're going, like, you have like 5 different markets within that one city, right?
Yeah.
So you could be overbuilt on one side of Salt Lake and then have astronomical demand literally 4 miles away. And so it's not quite that simple. Now, yes, there are cities and there are places that are overbuilt, but you also have to remember self-storage is coming off a phase where it had 3-4 years at 96% average occupancy. Now, the history of self-storage prior to this, the highest average occupancy that we saw was 86%. So it's not like people are like, well, it's rents are coming down and occupancies maybe coming down to say or whatnot. You're going, it was overdone. COVID wasn't real. Like, the effects of the economy were trillions of dollars poured in were not real, right? It was so overdone. The economy was so overheated. So storage, like most assets, are just getting into a new normal. And that's not a bad thing. Like, we don't even view that as like a downturn or a pullback, right? We're just returning to normal. The things that are actually the hardest in storage today is buying and finding them, because the owners, what they want and what people are able to afford when they buy with 8% interest, that gap is really, really large. So not a ton of deals are closing. Why? Because that spread, right, from the buy and the ask. So the biggest struggles that we're seeing is finding good deals that you can close on and getting an owner to come to the table. We do a lot of seller financing. Most of our deals are off market because of that negotiation period, and you got to find those deals. So will storage be overbuilt in some locations? Yes, just like every single other asset class will be built in some locations, right? That's part of it.
And every local business. I mean, every local business too. I mean, how many coffee shops can you have in a 3-mile radius?
Exactly.
I mean, every business has to face that and the competition that can come in, and how does that affect your
Yes.
prices and how much traffic you're going to get or occupancy in terms of self-storage. I mean, every business has to deal with that. But do you feel like there's much value in brand name and efficiencies and technologies and attracting that and distinguishing when you have like, there might be other operators or older places in town where it's just a different process, but you might be getting all the new people coming in because you've got a better technology, newer, better looking facilities. Can you distinguish yourself despite there being competition is what I'm trying to say. I know you mentioned earlier, it's commoditized in some ways, but.
Yes, customer acquisition. So basically you can filter out, if you are not a good operator, you'll never get it. Like you're like, well, people will see me because I'm on the side of the street. 85% of all our tenants come from mobile. 85%. So if you cannot compete on that screen, which people are very efficient at today, and people say, oh, well, that's easy, I just run and go. It is not. It is not that simple. If you can't compete on that, you will suffer in occupancy and rates. So the actual most important location you have is the location on the screen. So our technology and what we're doing on the customer acquisition point is, I mean, that is your differentiator. And we have markets where we're the ones that are competing. We are in by far the worst. We have a market where we are not even in the city. We are outside up on a hill by the airport, and we have the highest rents in the entire city. And people have to drive out of the city and come to us to rent us. We have renters that will pass 5 storage facilities to get to us, and they pay more. The only reason is because of how they all are horrible at that customer acquisition, and we're really good. Now, in most cities, especially first-tier markets, everybody is excellent at it. So all the REITs, all the big ones, they are dominating that screen, right? Yeah. They are competing. And you need to realize if you're going to go compete in Denver, then you better be ready to compete. Mm-hmm. And so name brand doesn't really matter as far as I'm going to go to my local public storage, right? That people don't, that's not how you buy storage. Yeah. They buy storage by saying, hey, I need a storage facility, and is it near me? But where brand comes in and why brand is so important, because that has to do with our overall ranking. It has to do on our domain authority. It has to do with how Google reads and sees us. And so how we're placed and how ads work. And this is not something you can just go do some SEO, right, and fix. Google has gotten very complex in how it ranks and puts authority on sites. That's where the name and the brand becomes important. It's on the customer acquisition, but not because of brand recognition, because of placement.
Yeah, I think it's funny, Aaron's comment at the beginning and what he took his takeaway from, your event on self-storage is funny because every other question I'm reading in is like, yeah, that's a business. This isn't just like finding a tenant in a single family or multifamily property, or it's like, yeah, it's a business. You're talking about Google and pulling up and being relevant and all this stuff and making sure your customer acquisition process is easy. I mean, we're thinking about
and what's your LTV? What's the lifetime value of that customer? How much can you afford to acquire that customer? Yeah. What are the products and things that we can add in? So how do we get our overall cart size bigger? And
those are all the metrics here in our business at Directed IRA. Like every day, we're opening, 30, 40 accounts a day, let's say. And like, but like, if you like, for example, I'll just give you if you Google the word self-directed IRA and, we're the #1 company that pulls up in natural search. Now we're not in a localized business. We're operating nationally, but that's significant for us. Right. And so how do you get that? Well, we do a freaking ton of stuff to get there. And it's not like we hired some wizard computer science person to figure that out. It's doing a lot of the hard work of running the business, having a good brand, having amazing content like webinars with AJ Osborne, doing podcasts and creating articles and all this stuff that we do, our 2 podcasts, like all that work. But that is what comes up and gives you that value proposition. It makes you relevant on Google, which is, I'm just like resonating with your message here.
It's work.
I didn't realize it. I didn't realize self-storage is as much of a business as you are. It's
intense.
This is great.
It's a lot to it.
Yeah. It's and that's what makes it fun though. That's what makes it great, because we can, like I tell people, if it wasn't a business, I couldn't change revenues. The market would place prices and I would live with the prices. And if I bought right and if the market went up, I did good. And if I bought wrong and the market went down, I just died. And there was nothing I could do about it. Where self-storage isn't like that. I can buy and I can dramatically increase revenues. And I can actually measure that and analyze that. So when we're looking at, we see these spreads and we can look at certain type of tenants and we can look at premiums to, or rates to income, and we can look at drive times and we can analyze all these things. We have a whole proprietary revenue management system that we have in-house that looks at something like 50 different factors for us to do rates and charge. That's why it's fun, right? Yeah. It's now too, you don't have to be that complex, by the way, everybody. We're a big shop. We are buying big assets that are institutional grade. If you go in a small town and you want to buy a storage facility, you competing usually means you answer the phone and you have a website, and then you're winning. Like, I'm not even kidding. My business model when I started was this: we're going to go buy in small cities. We are going to make people pay their bills. We are going to answer the phone and we're going to let people know we were here. That made us a lot of money. And that's all we did. It was just basic things. And that model works today across the United States because small towns, small mom and pop operators, they don't do those simple things.
Yeah.
Now, AJ, for people, I know some of you are probably, we're coming to the top of the hour to hop off, but we have selfstorageincome.com, and that has education, training, that live events that you do and other like specialty workshops. But is it cedar.cc for
so Cedar Creek Capital
side?
And you're exactly right. You can go to cedarcreek.cc or cedar.cc. And the Cedar Creek Capital, once again, my promise in the hospital was I'm going to teach, let people do it. Private equity is our Cedar Creek Capital. And then our education is self-storage income with the books, YouTubes, everything that everybody can go consume to learn more and
love that. Now, we did have a very important question from anonymous attendee. And the question is, AJ, that's an amazing Scottish beard. Do you use any grooming oils in it to take care of that?
You know what? I take care of my red beard. I got to keep that looking good. Us Scottish Irish people, we got to make our ancestors proud.
I learned that from Tony Robbins probably like 15 years ago. That's called a pattern interrupt. And lighten in some humor, and then we get back to the topics to get everybody's attention.
Nice. Yeah,
back on track. So,
well, let me ask Matt, this question from Joyce. Yeah, she asked, how do we get in contact with AJ for more info on investing with this company? Where's the direction there? I know we gave a couple of reference points of educational content.
If you go to our site, Cedar Creek, there's an Invest with Us portal, or you can go to selfstorageincome.com and there's an invest portal. You can also go to AJ Osborne on Instagram and just literally DM me and we can get you all, we can show you the information. We have portals where you can go in. We do developments, conversions. We turn office buildings into storage facilities, bankrupt super Kmarts. We do ground up. We do acquisitions. I mean, we do it all. So
I wonder what was happening to all the Kmarts.
Yeah.
Self-storage, huh?
Self-storage.
See another life. This Kmart's seen another life. There's another blue light special still out there.
There is.
And I would say this to people that need to learn more about this particular asset class in this industry. There's a lot of great education out there that AJ has for free. His YouTube channel, his podcast. Go to sign up for one of his boot camps, read his book, go to a live event and network, and like do your own due diligence about the industry. It's no different than when Matt or myself go into a new industry. Like we want to learn all that there is to it before we start wanting to go that route and use a self-directed or qualified retirement account. So lots of fun opportunities.
Yeah. We give away all our information. I view it. I say, I follow the motto is you give away the secrets and then you sell the implementation, meaning that we give away the secrets because I want everybody to know exactly what we do, how we do it, and everything in between. And then people send us deals and people give us investment capital. So that's the way to do it. So yeah, so you can go out and our podcast, YouTube videos, we're showing you how to do everything.
Matt,
Awesome.
let me lob over to you so we don't neglect this to our listeners, because this is like, your area of expertise, our area of expertise at Directed IRA. But can you talk a little bit about some do's and don'ts with IRAs, how you can get started in IRAs? We talked a little bit about, of course, you can do it with the syndication, but how can you just use your IRA to like buy one yourself? So we got a lot of questions about how can I do that with my IRA or solo K? And what structure should I be doing?
Yeah, I think for anyone wanting to use their IRA to do their own deal, okay, you're going to go find your own self-storage facility or convert something into it or build new using your own IRA or 401k. You're going to want to use an IRA LLC. And depending on how much cash you have, you're going to be able to go out and acquire that asset. Now, AJ talked about seller financing, on some of their deals. They may do that. You're going to probably want to chase that. One of the issues, of course, on a self-storage deal, and this depends on how big it's going to be, what market it's in terms of the cost and everything. But typically the banks aren't going to do non-recourse loans. You can get a non-recourse loan to buy a single family rental or something like that. And there's banks that lend on those. We have lots of them we're working with every day on that type of deal. But in self-storage, there might be a couple lenders interested in it actually, but you're probably going to be at a 50% loan to value ratio would be my guess. And you're going to, so I wouldn't expect guarantees on finding a bank to do a non-recourse loan is kind of the message, but it might be possible. I've seen a lot of the non-recourse lenders do loans on agricultural property. I've seen it on commercial. I just don't ever think I've seen one on self-storage directly from an IRA.
I haven't
directly. Okay.
I haven't yet. No. And I've been, yeah.
So you're gonna need to get some creative financing is basically the deal, or some private lenders if you're going to bring debt into the deal. Obviously your IRA could buy the deal with cash, and we have clients with large IRAs that could execute those deals. But you're going to want an IRA LLC to own the asset. But you're probably, in this instance, you're going to need an operating company or some operator or management company to run the thing, because you can't. Right? This is not like a single family rental where you might get away with not having a property manager. The self-storage facility is typically going to require more work. It might require some more labor, a lot more involved in the leasing and the checking on things and the kicking the stuff out and cleaning a unit out. I just think it's going to be more work. So, you're going to need a management company involved for sure. So those would be a couple of things to consider. Any of the lawyers at KQS Lawyers could walk you through using that IRA LLC. You can partner with people too. That's another way we've seen that in a lot of just commercial real estate in general is, hey, let's get 5 or 6 people together. Some of them use IRAs, some of them use personal funds, and we just kind of partner up into an LLC that goes out and does it. That could do a self-storage deal. I've seen that a lot in the multifamily or small multifamily or just even commercial office.
Anybody does that, we actually do. They act like a fund of funds, and we actually do a totally different structure for them. We're like, if you're going to bring us a big group of money together, we'll give you a totally different deal and structure, and we'll take out stuff, and you're acting more like a partner. We actually think that's one of the best ways to do it, because that's what we do. Yeah. We're getting other people together, right? I mean, and for individuals, all of a sudden you can you get more equity, you get more, it's real estate. You're better. The more you do, like, numbers works out better for you.
Right. Yeah. So I think lots of options though. And I do think what we see more is people investing in other operators' deals, like an AJ or something like that, where it's, well, let me just invest in your deal, whatever the structure may be, and whether it's a fund of funds concept, you're combining multiple sources of funds or individuals in a small partnership or deal, or you're just going direct in to his fund or some other operator. I'm just, not endorsing AJ here, of course, make your own investment decisions, but
we do like his beard.
Yeah, we endorse the beard though, because there's no liability there. All right, well, I want to come back to a point, because I said this and it blew off a ton of questions in the chat. And I don't mean that in a negative way. There's a lot of questions that came up. Yes, we do group 401k plans that you can self-direct. My partner, Mark, and I in our law firm, KQS Lawyers, I did them for years. The problem is they're very complicated. So you've got to be determined. If you're like, oh, I want to do it for myself, invest 50 grand, it's not worth it. It's not worth it. But if you're like, no, I want my employees to use this, I'm going to use it. I'm committed to this. I love self-directing. I'm willing to pay $5,000, $10,000 in fees. It's possible. Okay. It's not like $300 for your IRA account, $395, a year to self-direct an IRA. So it's a little more work to do, but it is what I do. Our 401k plan is self-directed, and that's unique. But we love that stuff, of course. So we've figured it out. So in the law firm, I'll just say this: Kevin Kennedy's the lawyer in the law firm you'd want to chat with on that, and we have it now. Right now, if you're setting up a new 401k, most of those are safe harbor 401ks, and we're going to have a webinar later on this. So, but I just want to mention this because it came up. It's if you're setting up a new 401k this time of year, you're past the September deadlines of when you need to set up for 2023 purposes. So you'd be setting it up to be effective in 2024. So this would be a 2024 401k plan. But stay tuned on that. Again, make sure you're signed up to our newsletter, because you'll get a notice on the webinar when we come out on the group 401k. Like I said, it's possible now. We're just not putting a lot of educational content on it because I'm getting the team to kind of walk before they can run with that.
Okay, before we end, I want to toss over a tax question in regards to UBIT for this type of investment.
Oh, you want to end with that?
Yeah, well, we're going to end with another one. I'm going to find a good one. We're going to hit the tax one, and we'll end on a high note. Let's get the tax one out of the way. I literally, like 7 people, I think, we're just dying to know about UBIT. Do I need a blocker corp? Like, let's address that, because they're seeing this as an active business for myself, or if I invest with AJ. There's 2 different scenarios, right? Me doing it without a syndication. Another scenario, hey, I'm going to go into a syndication.
Yeah. Let me ask this, AJ, because this is a good question. When you do your K1s, from the fund, is it rental income coming through at the end of the day? Or is this like ordinary income? I don't know if you know that question. Well,
that's going to depend on the individual, because the individual's own tax status will actually change it. So some people, it won't be ordinary income. It will actually be real estate income, and other people, it won't. So I don't want to say one way or another, because that changes based upon individuals. But it is a pass-through ownership, the same as it is for me. So the owner, you own the equity portion, and you are getting a distribution from the ownership. Now, the great thing about real estate is we can run at a loss and still give profits, because we can capitalize a lot of expenses. So that is very obviously advantageous. So I like to make a profit in cash, but a loss on paper.
Right. Exactly. So, okay. So let me unpack this for some people. And this is a little complex question, because self-storage, like a number of businesses, it's a real estate play, but there's a business inside of it. But just think of like the dentist that owns their building and practices out of it too. We talk about this a lot in the Main Street Business Podcast, and this is kind of like owning a business, but owning the property too. And I don't know how you structure this stuff, AJ, so maybe you can hang with me on this example and tell me how you structure. But a lot of times, like if let's say you're the dentist, okay, or even me, lawyer, like we own the building or the space that we're in 2 of our office buildings for our law firm. Well, we're an operating law firm, but that's the tenant. We own the real estate in an LLC, and our business pays rent to our own LLC that owns the building.
Yep.
Now, in that LLC, I'm getting rental income down to me, right? From owning the real property, I'm getting rental income. When we sell it, we're going to get capital gain income, even though I got a business that's in there operating, paying the rent. So is that
it's a loss to the business? It's a loss to the business, and then it's coming back to you as rental income. So our business, like the storage, is a business on top of a real estate, but it is not qualified as a business. It is real estate income. And so it's just like, hotels.
Exactly. Yeah.
I think it's hard to call, hotels traditional real estate. Most people look at a hotel and say, this is a full functioning business that is overlaid on real estate, but it is a real estate asset. It's the same as storage. It's rental.
Yeah. And so when you're investing in the hotels, and we have clients that do that too, right? You know, you're owning the real property. You're owning a
Yep.
share of the LLC or limited partnership
Yes.
that owns the property. And then they go hire Marriott to go manage it, you know, or whatever.
Yes.
And there's a cost to that. That's a cost to
Yeah.
the ownership of the real property and that branding. And there's a whole business model there. So, so that's, I guess, the answer, guys, is you're investing in the LLC that owns the property.
Yes.
And then there's the operating business that is operating it. But at the end of the day, there's rental income passing through real estate income if there's gain, capital gain. So, so what you would need to be careful on, the only thing is, so there's not UBIT to be able to classify it as rental income because you own real property, like, right?
Yes.
Like that's the bottom line, AJ, is like,
that's the bottom line. You
we
own
own real
estate.
property and we're
That's
getting
correct.
rent for the use of real property, right? I'm not charging you services, right? There might be add-on fees for certain things, I presume.
Yeah, there's like add-on fees stuff, but it's not considered business income.
Yeah. So, so that's the answer. So there's no UBIT in terms of, is this an operating business? I know we've talked about it from an investment standpoint. It is more like a business than a single family rental, but from a tax standpoint, it's still rental of real property.
It's still rental income. That's the beauty of it. That's why I like it.
Yeah. So it's also on a tax return. So then you would just have, for anyone with IRAs, you would need to know, like, are these leveraged with debt? Almost all of them are going to be. So then you'd want to look at any UDFI, and we can obviously help calculate that in the law firm if you want to kind of look at that. Now, AJ talked earlier about, and just following back on some of his comments is he, you know, he's taking all the depreciation and all the capital assets and have cash flowing it, but not as far as on paper with the IRS, there's a tax loss. And so if that's the case, and this is on any asset for anyone, this could be a multifamily investment or whatever, this happens a lot. You're cash flowing, you're getting distributions, but your K1 for your IRA is a zero, you know, or it's a loss. So there's no UDFI to calculate year to year, even when you're cash flowing. But where we do see that, of course, is when the asset sells and there's a large gain, the property still has debt on it, you could have that UDFI tax. But I've always been of the mind, if you're buying into leveraged assets that are providing more return than what you're getting in the stock market, what do you care at the end of the day? You know, it's at the end of the day, you're going to net more money. So, but it's good to know that should be a calculation to keep in mind.
I'm going to make a comment. AJ, I think you're the first guest, and we do a ton of these, like, since we started Directed IRA. You hopped into the Q&A yourself while you're on there and you're answering questions. I was just looking, I was like, wait a minute. I'm like trying to grab a few more questions. I look and it says, oh, AJ answered them, typed it in. well, that's pretty cool. That's pretty cool. Let's end here. Are there opportunities that you have for both accredited and non-accredited investors? And what kind of minimums are you looking for people out there that are wanting to be completely passive and just, you know, do a syndication?
Yeah. So we do, we're going to be offering our first non-accredited investment here soon. As of right now, all the ones that are open, which are 3 developments, which are in Arizona, downtown Boise, and then the Boise area outside a city called Eagle. We have 3, and then we have a portfolio of value add properties that are in multiple states that are underperforming assets that we are turning around and expanding, and that's in a fund. And all of those we will be closing out in the next 2 months. So the value add fund is open with 4 or 5 properties in it, including expansions, and then the 3 developments, which are syndications, they're separate. So you can look in there, and some people want a development, other people want, you know, cash flowing assets, but we're turning them around, and they're huge opportunity there because there's also expansion. So those are for accredited investors. The minimum, usually for the first time investor, we will allow, I think, $50,000. I think they're doing that. Normally our minimum's $100,000 though.
Awesome.
All right. We did it at the same time.
Yeah.
All right. So like, if you go to Directed IRA, better. I know. We always have a great discount to open a new IRA account. You can go to directedira.com and book a call up in the upper right. You can schedule a call with one of our senior account reps, enter in webinar 50 and get $50 off your first year annual fee. course, we have AJ's information at selfstorageincome.com and cedar.cc. And then we'll save the best for last. We got an upcoming self-directed IRA summit next week in Raleigh, North Carolina. Go to sdirasummit.com, and that's a full day Matt pretty much teaching. So we'll just like do a deep dive. Okay. Oh, we got it up. Hey, look at that. There we go.
There we go.
We got a discount code.
Yeah. And if you guys can't make it to Raleigh, you can get on the virtual. We'd love to see you in Raleigh too. We got a VIP event, and we're doing the Raleigh version of Top Golf, and they have a cool outdoor patio and everything we'll be doing that night. But it's cool to just see other people self-directing. We'll have some of our larger account holders there talking about strategies and things that they've done to grow into, 7-figure self-directed IRA accounts. And
it'll be,
so it's going to be
awesome.
A good time.
AJ, do you have any final words for our listeners and watchers today? Any final words of wisdom that they need to hear?
I don't know about wisdom, but I do know this. Self-storage, although it's the newer food group amongst commercial real estate, self-storage is at a different life cycle than most. Retail, others, they're on the end. They're in the nursing home. The yields will not be like they were previously. And storage is the opposite. Storage is just becoming an adult. And its yields, that's why for 26 years, it has been the top performing real estate asset class out there. And its yields may not every single year beat all the other ones, but it will consistently be one of the top performers in the real estate asset class. So no matter how you look at real estate, I think it's vital that everyone has exposure to storage, just like you would multifamily or anything else in your real estate investing and portfolio. People learn that way too late, and they missed out on what was one of the greatest real estate runs we've ever seen in the United States.
We can count that as wisdom. That was good wisdom. We'll count that.
Yeah, okay. I like that.
You're going to call it. I mean, I wouldn't, but
I think it's interesting how you kind of wrap that up, because you started talking about demand at the very beginning and how critical that is. And I think if you think from a macro perspective, commercial real estate and the different categories of that, retail, very concerned about how that's going to be. You called it in the nursing home, right? Technology. Do people actually go to the store anymore? Am I just going to buy more on Amazon and continue to shop more and more on Amazon? Commercial office has been affected from COVID. Are people going to continue to work from home? Are they not? And self-storage is like, yeah, people still need an affordable place to put their stuff.
Yep.
Right.
The economics making self-storage are actually getting better for storage, worse for everybody else. People think it's just because people are hoarders. That's actually not true. It's a combination of the overall price increases on real estate combined with regulation. So we live in a fraction size of lots, and the regulation as far as HOAs and city ordinances go on those lots are like 150 times what they were 10 years ago, 1,000 times what they were 30 years ago. So 30 years ago, if you wanted more space, you just built a shop. You can't do that. You can't park things on the driveway, everything else. So it's a price problem in real estate and a regulation problem that drives people to storage. And that's including businesses. Some of our facilities have 30% utilization of businesses because their ROI of taking a big room in their office to hold their crap makes no sense because real estate's so expensive. So unless you think real estate prices are going to go down dramatically and regulation is going to get less, self-storage will keep being a very, very needed thing.
That's funny. Even as we're talking this whole time, Aaron and I just yesterday leased a self-storage spot, facility, whatever you want to call it, unit for our business.
Yep.
You know what I mean? Just yesterday. Connect that. You talked about that. There you go. How's that for demand right there? We just did it yesterday.
Month to month, 160 bucks for a cage.
Yep.
Anyways, so well, I want to just thank you, AJ, for coming on, sharing your wisdom, all your insights and expertise on self-storage. Also, your personal story there. I really appreciate that. I think that helped understand where you came from and how you got into self-storage. Thanks for sharing those details. And then, of course, the red beard. We just appreciate that too.
It brings the game. It's the only people really. I could say anything. It just sounds good.
It's the AJ game, the A game.
Right. Thank you guys for having me on. This was
All right.
awesome. Appreciate all you do.
See you, everyone.
Thanks, AJ. Take care, everyone. See you next time.